Hello there. In this video today we're going to be talking about the return on equity ratio and how it is an important measure of a business's profitability. The other ratios we've already looked at have measured profit as a comparison to sales. Now we're going to be looking at how much profit a business has made in comparison to how much the business is actually worth and how much the owner had to contribute in order to earn that net profit. The more you have invested in something, the more money you've invested, the more time and effort, the higher the return you expect to make. If I have earned $50 in profit, that doesn't tell you much. But if I tell you I earned $50 in profit and I only put $1 into my business, you're going to think, yeah, that's great. You know, that's a good return. But if I was to put in $50,000 and I made that same return, I'd be very unhappy with it and I'd be expecting more. So the importance of this ratio was to look at how much profit you made relative to how much money I had to put in order to earn that amount of profit. This works in the share market too. If you invest $10,000 in shares and you make a $1,000 return, I'd be pretty happy with that. That'd be great. But if I had invested $1 million in shares and made $1,000, it's not as good. And then from the other extreme, if I've invested $1 and make $1,000, that's amazing. So the amount of net profit you make is relative and does matter. You do need to look at that in comparison to how much you had to invest in order to earn that. So let's have a look at how you calculate it. The way it's calculated is you want to take your net profit, and remember that the net profit is the link between both of the financial statements. The statement of profit or loss will calculate the net profit, and it will also then be added to capital at the end of your statement of financial position. So the key figures I'm going to be using here is net profit, and you'll see it just there. And I also want to find out what average owner's equity is. The way that you find the average of two numbers, remember, is to add them together and divide by 2. If I wanted to find out the average height of every single person in our class, I would add up all of your heights and divide it by however many there were of you. When you're looking at this ratio, it's the same. You want to take what you had at the start for capital, you want to take what you had at the end, add them together and then divide by 2. When we're looking at this example, that would be taking opening capital, which you'll find up here this is a modified extract of a statement of financial position right at the bottom in the owner's equity section. The opening balance will be here and the closing balance will be down the bottom. The opening balance this time will be exactly identical to the closing balance in the previous year. So if I was looking at these were 2020 figures, and if I was looking at the 2019 figures, I would see the closing capital balance, closing owner's equity balance down there would be the same as what I start with up here. So moving on from that, let's write down the formula for this now. Let's write down the formula for calculating owner's equity, return on equity ratio. I often like to abbreviate return on equity to ROE. So the ROE, return on equity, is equal to my net profit. It's the same start as the net profit ratio. So the net profit ratio also has net profit on the top. Then I want to divide it by average owner's equity. It's a bit hard to rub out on this board, I apologize. Average owner's equity. And the way I would calculate the average owner's equity based on the figures that I have over here, let's substitute these figures in now. I grab the net profit, which I can see there is the $10. Again, I've used very simple numbers to make it a little bit easier for us. And to get the average owner's equity, I need to put it into brackets. If you're in Excel or if you're on your calculator, you'll need to do the addition first. So if you were doing this in Excel, you'd need the brackets because otherwise Excel is going to do the multiplication first. So in brackets, I would put the opening owner's equity, which is 100. I would then add to that my closing owner's equity, which is the 60, plus 60, close the bracket, and then I would be timesing that number by 2. And if you put all of that into your calculator, you will end up getting in here, you'll end up with 10 over 80, which at the end of the day will give you 0.125. Now remember, if you want to express this as a percentage, you would times this by 100. And that's how you'll be given the ratio. You'll be given it as a percentage. So if I was to show this as a percentage, I would get 12.5% return on equity. What this means is that from each dollar I have invested in my business, I am getting 12.5 cents return on that. And And you want to be able to compare this number to work out if that is a high number or not. Well, what do you compare it to? As per usual with the other ratios, you compare it to what you had last year and you compare it to the industry average. But with this ratio, we have more things that we can compare it to than just that. We can also look at the return I could be getting on shares. I can look at the return I could get on having a rental property in the property market, and I can look at what current interest rates are right now. At the moment, interest rates are extremely low. I had a look at my bank account recently, and my interest is less than 1%. So this is going to be far better than just leaving my money sitting in the bank account. 12% is also higher than what I'm likely to get in the stock market right now, but again, fluctuates and changes all the time, and if you're really good at picking stock, then you could do better than that. So you do need to compare this with those things. So what does it mean if you get a high ratio? A high ratio means that your business is generating a suitable return to the owner, and it is a good investment choice. If you get a low number, it's the opposite. It's a poor investment choice, and then perhaps the owner should consider alternative investment options. A good ratio also indicates management efficiency, and a bad ratio indicates it could be management inefficiency and issues with the way the business is managed. The other thing you want to look at as well with this specific ratio is it is different across different industries. Someone who has a business with a lot of capital required, so expensive businesses that cost a lot to run, are going to have a far smaller return on equity ratio. Things like theme parks, airlines, they've got a lot of money they need to put forward to buy the equipment within their business in order to run it and operate. So they're going to have a lower return on equity because they have a higher required amount of equity that they need. The owner needs to invest more money into that business because it's more expensive. So the return on equity would generally be lower for them. If you've got a business that doesn't cost a lot to run, doesn't require a large amount of money investment from the owner, things like an online store where you don't have to physically cash out a lot of money to buy expensive assets, that would be a lot bigger. You'd get a lot of greater return on your investment. There is something you do need to be aware of with this ratio though, is you want to make sure you don't have, look at the amount that they have invested versus the amount of debt that they have. Because you don't want to have an over-capitalized business or an under-capitalized business. That's going to skew this ratio. So what does that mean? It means the amount of debt that you have. I could magically make this ratio look amazing without improving my business at all by taking money out of my business and just get a huge loan. You don't want to do that, but it would make this ratio look better because now I've got less equity. My average owner's equity is going down, so it's going to be smaller relative to the amount of profit that I've made. But it doesn't actually improve the business, so that's not advice that you would give. But it does help to understand this ratio. Maybe it improved because the owner took money out of the business. And that might not actually help the business, but it makes the ratio look better. So it is something to be aware of when you're analysing the business's reports, is have a look. We want net profit to be high relative to average owner's equity, but we don't want to do that by just taking out money. That's not an effective way of improving this ratio. So what is an effective way of improving this ratio? The best advice I can give here is to improve the profit of the business. That's the main thing. And make sure you don't have any assets that aren't being used. Make sure that all of the owner's investment is being put to a good use. And you don't just have things around that aren't generating some kind of income or helping the business in any way. The other thing you want to do, like I said, is just check to see how capitalized this business is. How much are they relying on debt? Because the business might look amazing, but it might not actually be very good if you have a huge amount of debt. Because yeah, you didn't have to put much in, and the amount of this ratio is measuring how much profit you make relative to how much you had to put in order to make that profit. So have a look at that. Because if you are a highly capitalized business, it's going to be harder for you to get a good ratio. And if you're relying on debt, it might make it look like you've got a better ratio than you actually do. So have a look at those factors. And why might this ratio have gotten better or worse during the period? That's important too, to be able to look at the figures and see why it's changed. If the ratio got better, it's likely that the net profit has increased and or owner's equity has decreased. Because remember, this is looking at how much profit you made relative to how much the owner has contributed. Alternatively, if it's gotten worse, maybe your net profit went down and the owner invested more money into the business. That would make the ratio worse. Hopefully that made sense, and as always, if you have any questions, please let me know, and I'll see you next time. Bye.